Today we're diving into a really powerful and frankly pretty controversial idea. How do you turn a volatile growth stock into a high-yield income machine? We're going to be taking a close look at the new YieldMax RDYY ETF, really weighing that promise of a big monthly payout against the considerable risks that come with its strategy.
And that brings us right to the heart of the matter, the big question for any income investor out there. Could an ETF like YieldMax RDYY actually be a sound addition to your portfolio? Or, when you get right down to it, does the risk just outweigh the reward? That is exactly what we are here to figure out together.
To get to a clear answer, we're going to break this down into 6 key parts. First, we'll touch on the allure of high yield itself. Then, we'll look at the case for Reddit as the underlying stock. After that, we'll deconstruct the covered call, the engine behind this thing. Then we'll formally introduce the RDYY ETF. From there, we'll get into the big yield-max trade-off. And finally, we'll wrap it all up with our final verdict.
Okay, let's dive right in. The fundamental appeal here is actually pretty simple, but it's incredibly powerful. We're talking about taking a high-flying growth stock like Reddit, a company that pays 0 dividends, and transforming it into a source of consistent monthly income.
So, the core idea, the value proposition, is really straightforward. RDEdge is specifically designed to take those huge price swings in Reddit stock, that volatility, and convert it into monthly cash distributions for you, the investor. That's its entire purpose.
Now, to really get a handle on this ETF, you first have to understand the stock it's built on top of, Reddit. So let's take a moment to examine the specific characteristics that even make it a candidate for this kind of income strategy in the first place.
Wow, since its IPO back in March 2024, Reddit stock has just seen explosive growth. We're talking over 300%. This really paints a picture of a high-momentum asset, doesn't it? And it's exactly this kind of powerful upward move that presents both a huge opportunity and, as we'll see, a major challenge for the income strategy we're about to dig into.
And look, this growth isn't just market hype. When you peek under the hood at the fundamentals, you see some real strength. In the second quarter of 2025, Reddit's revenue shot up 78% compared to the year before. And that was driven by a huge expansion in advertising and some of these new AI data partnerships. It really suggests that a surprisingly robust business model is starting to take shape here.
Okay, and this chart right here reveals the absolute engine of the RDYY strategy, and that engine is volatility. You can see Reddit stock volatility is hovering around 65%. To put that in perspective, that is more than 4 times the broader market. It's this extreme price movement that allows option sellers to demand really high premiums, and that premium, that's the cash this ETF is trying to capture and pass on to you as income.
All right, so we've talked about the engine's fuel, volatility. Now let's look at the engine itself. To really understand RDY, you absolutely have to understand the option strategy it uses, which is the covered call. And this strategy is built on a very fundamental trade-off between generating income and capturing a stock's full growth potential. So, what is it? In the simplest terms, writing a covered call means you agree to sell a stock that you own at a preset price sometime in the future. And in exchange for making that promise, you get paid a cash premium right now, today. That premium, that's your income. And this is where we hit the inherent compromise, the real trade-off. You see, that same high volatility that creates those fat premiums for income also means the stock can have these absolutely explosive rallies. So by selling that covered call, you collect the income, sure, but you give up. You forfeit most of the gains from a massive surge, like that incredible 62% jump Reddit saw not too long ago. To put it bluntly, you get paid, but you might just miss the moonshot.
Okay, so now that we get the strategy, we can finally introduce the specific investment vehicle, the RDYY ETF. And it is so important to understand that this fund does not do this the old-fashioned way. It uses what's called a synthetic structure.
So let's run through the key facts here. RDY slated to launch in early September 2025. And crucially, it uses a synthetic covered call strategy. What does that mean? It means the fund doesn't actually own a single share of Reddit stock. Nope. Instead, it uses a complex mix of options and other derivatives to basically replicate the position. And it does all this with one goal in mind: delivering monthly income to its shareholders.
Now, for any potential investor, the cost is always a critical piece of the puzzle. The RDYY ETF is going to carry an annual expense ratio of 0.99%. That's the management fee that's deducted from the fund's assets every year.
Okay, so we've got the strategy and we've got the fee. But how does this kind of thing actually play out in the real world? To really assess RDYT's potential, we need to look at the track record of similar funds from YieldMax and really wrap our heads around the risks that are just baked into their model.
And this comparison table is, well, it's pretty revealing. You can see that RDY is part of a bigger family of these single stock ETFs from YieldMax, like TSLY on Tesla and NVDI on NVIDIA. And they all share the same 0.99% expense ratio. And much more importantly, they share the exact same risk profile. We're talking about exposure to a single, very volatile stock, a capped upside, and the very real potential to significantly underperform when the underlying stock goes on a bull run.
So let's be crystal clear about the key risks involved here. The single most important one to understand is the asymmetry. Your upside is capped, but your downside is not. You're fully exposed if the stock falls. And those monthly payouts, they are not guaranteed. They can vary wildly or even stop altogether. Plus, because the fund uses derivatives, it introduces complex risks like counterparty risk that you just wouldn't face by owning the stock directly. You know, this quote just perfectly captures the danger for investors in a stock like Reddit. It says that covered calls are great until they're not, because when you get a sign during an uptrend, you forfeit that upside. This strategy works well when the market is flat or just slowly climbing. But during a major bull run, the cost of giving up those huge gains can be absolutely staggering.
All right, so after weighing all the evidence, the promise of income, the mechanics of the strategy, the historical precedent, what's the final verdict? Let's bring everything together now to answer that central question and hopefully help you make a much more informed decision.
The conclusion here is that this ETF is a highly specialized tool. It is definitely not a one-size-fits-all solution for every portfolio. So who might it be for? It could potentially be suitable for a very specific kind of income seeker, someone who is completely comfortable with high volatility and has a neutral, maybe even slightly bullish outlook on the stock. But on the other hand, if you're a growth investor who wants that full upside potential, or if you simply have a low tolerance for losing your principal, this strategy demands extreme caution.
So in the end, we're not going to conclude with a simple buy or sell recommendation. Instead, we're going to leave you with a question directed squarely at you, the investor. After reviewing all this, you have to decide for your own personal goals and your own risk tolerance, is the powerful allure of a high monthly yield worth the very clear trade-off of capped gains and full downside risk? The answer to that, well, it's going to be completely unique to your individual situation. And with that, if this deep dive into RDY was valuable for your research, we'd really appreciate it if you'd support Finbot Insights by clicking that like button and subscribing for all of our future analyses.